Welcome to Legacy Money, the show to help you live more, give more, and leave more. I'm your host, Barry Page, and we got a great video for you today. I'm not here to entertain you. I'm here to educate. It's going to work a little different, using a little different format. I've been told that if you can't explain it on a piece of paper or a napkin, then it's probably too complicated. So we're going to use some technology, and I'm going to explain everything right here on a piece of paper. We're going to talk about the infinite banking concept and how you can use it in your life as a part of your financial plan or as a standalone plan. This circle represents your personal economy. It contains cash flows. Now, we all have a circle. The difference is some people's are bigger or smaller, but that's relative. What we do have in common is that we all want our circle to grow. So today we're going to discuss how you can do that and how you can protect your personal economy from predators, eroding factors like taxes, inflation, interest, and fees. Now, if you've watched any of my other videos, you know I'm an advocate of the infinite banking concept. I'm an IBC practitioner. And if you haven't learned about how IBC works, then you'll want to check out some of my other videos on infinite banking and how IBC works. In this video, I'm just going to provide further insight into infinite banking. And we're going to compare it or actually utilize it with or as your financial plan. Of course, this takes time and it takes effort and upkeep. This is something that you would be in control of. And I'm not suggesting that you would want to have your entire financial plan be infinite banking, but you could do so. I've actually transitioned most all of my assets into IBC. Now, you've probably noticed that things aren't going exactly as planned with our national economy. And you may be concerned about your money, your financial future. If you have money in the stock market, mutual funds, an employer-sponsored 401k, an IRA, or the like, you should be concerned. The markets have been extremely volatile for a while, and they're currently at all-time highs. With every whisper from the Federal Reserve, the market goes up, it goes down. And so you just have to think about what's really going on. Many economists are suggesting that we're in a bubble, and it's past time for that bubble to pop. And if history is any indicator, then we're probably near that time. But let's talk about what you can do to avoid some of that risk and secure your financial future. The good news is you can start today. And it's a real simple plan, so I'm going to just draw it out for you on pen and paper. Now, if you do have stocks, mutual funds, or 401k, that's fine. This plan, the strategy will actually work better or help those plans to work better because you'll have safe money to depend on when those accounts have losses. This strategy is designed to help you improve your financial position, so you can grow your economy, okay, without unnecessary wealth transfers. And so you can accumulate an ever-increasing pool of capital that you have access to, liquidity, control, and uninterrupted compounding. Now, one of the keys of infinite banking is that the money, the capital, must be accessible through collateralization. Now, important in this time that we're living in is that you can move your capital, your money, off the public grid and into a private account where it's not subject to unnecessary taxes and fees. You can actually build your system to accommodate all of your wealth and keep it in the family. Now, when we talk about a financial plan, of course, there are many types of plans. There are estate plans, there's retirement plans, college savings plans, health savings plans, tax plans, and perhaps even you may have a business plan. What if you could replace all of those plans with one simple plan? So you didn't have to hire administrators, advisors, attorneys, and accountants whose plans may differ and may not always match up to what you want.
Too many chiefs and not enough Indians, too many running my job for me. Don't need anyone to count my money, don't need it.
Ironically, rarely do we find advisors that want to invest in their own self-education. Most of them teach and advocate exactly what they've been taught in school. They have blinders on. So you're going to have to open your mind away from traditional thinking for just a little while to grasp this. So let's talk about a financial plan. With any plan, you want protection, right? You want to protect your money. You want to protect your hard-earned labor, what you've done. You also want savings. You want a place that you can store your capital and save it where it's protected. And most people, growth, a return, is the first thing that they answer when I ask them what they're looking for in a financial plan. They want a return. So we all want that, but I would encourage you to think that protection should come first, because that is the foundation, and we must protect our income and our lives. And there are a few other very important considerations that I'd like to add. Things like liquidity, use, and control of your money. And we should always want the most tax efficient plan possible. Many people pay for expensive tax attorneys and complicated trust and plans, and those may be necessary in some cases if your wealth reaches a certain level. However, for the average family, most people can do many of these things on their own. Now, there's a few ways to get money, capital, into our personal economy. First, we all think of our earned income, right? There could be passive income that you receive from assets that do not require your activity. Or if you're fortunate, you may have an inheritance. Regardless, we have to store our capital somewhere. Wealth has to reside somewhere. So it goes into our economy, and then we may spend money on expenses, right? Things that it costs us to live, our cost of living. But there's also wealth transfers. Now, these are very important and oftentimes overlooked. Again, things like taxes, interest, and fees, which all cause a drag on our money. Now, what most people do is they take some of this money and they save or invest it elsewhere. Typically, this will be in a bank or with a financial institution that manages this money. Now, the problem with this is that most people have the majority, if not 100% of their savings investment in a qualified plan, a mutual fund maybe, or some type of retirement account. So it's subject to risk, market risk. All of this money, if it's in the market, is at risk, and you could lose it all. Having all of your money in the market is a risk that you shouldn't and don't have to take. We believe the markets, and tax laws for that matter, will remain volatile. So it's hard to protect your future with these uncertain plans. What happens when these plans fail because of market crashes? Could you wait for the markets to recover? Most people don't realize that the Japanese stock market still hasn't recovered after 30 years. And the European stock market has been down for 20 years. Now, at some point in life, we will either retire or will no longer be able to work and produce earned income. Nelson Nash referred to this as passive income time. He didn't like the word retirement. And we would like to think and hope that this time would be as comfortable and as enjoyable as possible. So you didn't have to worry and you didn't have risk. More importantly, it takes money to live though. And with this strategy that I'm about to lay out for you, you have access to capital over your entire lifetime with benefits that you can't find in other plans. So let's take a look at the big picture. You want to protect your assets. You want to protect your income, your cash flows, and you want to protect your family if you have a spouse and children. So they and you can enjoy the fruits of your labor without fear of loss. And you want to save money. You want to put money into your circle, into your personal economy that you can access later, perhaps for retirement. But perhaps this is an account, or it could be a business. At some point, whether you want to retire or you're unable to work, maybe you're sick, or you've just gotten old and you can't work, you will need income. It costs money to live. So let's recap. You want protection, you want savings, you want growth, you want liquidity, access to your capital, you want use of the money, you want control, and you want tax advantages. Now, there aren't too many accounts that I know of that can provide all of that. Actually, the only plan that I know that can offer all of that is a custom designed life insurance plan. Specifically, this plan can be built with the financing ability utilizing the infinite banking concept. And that's what I want to lay out for you here. So imagine having an account that you have complete control over. Without penalty, you can access the money at any time. Without tax penalty. Now, this account would be secure, meaning you couldn't lose the money because of a market crash. It's uncorrelated to the stock markets. And this account would be protected from predators, things like lawsuits in most states, and it would be shielded from taxes. Now, having an account like this does require responsibility. You are in control of the account and you would be responsible for maintaining it. However, that's where you have the help of an IBC practitioner, an agent that specializes in this type of thing. But education is key. It is mandatory that you learn how infinite banking works, and the main thing would be to read the book, Becoming Your Own Banker, from the late Nelson Nash. It's required reading. Now, the strategy and the process are simple. However, many people often get confused because they try to compare IBC, infinite banking, to other traditional plans. Nelson referred to these as human problems, Parkinson's law, and the arrival syndrome. So if we can just get over these hurdles and think about what's really happening with our finances, then we can start to understand the concept. Those that have a business mind, maybe you're already in business, they usually grasp the concept rather easily because they understand profits and expenses. Now, you probably know you should have an emergency fund. So your personal economy, your IBC plan can provide that. And the good thing is this account would grow over time, guaranteed. You have access to the money without taxes or penalty. So let's get into the specifics. So I've already explained that we're going to utilize a custom designed life insurance contract that you own and you control. Now, people are always asking, what is the cost? Well, the cost is up to you. It's relative to how much you want to store in your personal bank, your personal system that you will use for cash flow, for protection, and for growth. All right? So let's talk about that real quick. You have a base policy. So let's say you decided, now it's all relative to somebody's age, income, and their goals, right? So your agent, the IBC practitioner you're working with, should be able to help you with this. So your policy has a base premium. Now let's just say that base premium is $10,000, okay, for a year. Now you could pay that for 1 year, 10 years, to age 65, to age 100, and mortality, according to the CSO tables now, age 120. But it's all dependent on what you want to accomplish with your plan. Now, typically, traditional whole life policies have been for 100 years, to age 100. They're now to age 120. So that means the premiums are due until that point, all right? But that doesn't mean that you have to pay premiums all those years, but you will probably want to if you understand how this works, because you own and control this asset. You can put additional monies into this contract. Now, it could be more or less, but we're just going to say that it's $8,000. So a total of $18,000 went into this contract. This would be a year. And let's just say you did that for 10 years. Now, again, it's all relative to how old you are, your income, and all of these things. So everybody's contract will be different. But if you did it for 18 years, for 10 years, you would now have $180,000 in this plan. And you may be asking, well, so why would I pay more than the premium? Nelson used to always answer this by saying, have you ever heard of anyone saying they had too much money in the bank? Now, in this day and time, maybe you have, because people want to get their money out of the banks because they're concerned about things. But this is your bank. Can you have too much money? So $180,000 after 10 years. So over that time period, and in the first year, for instance, you may have access to $8,000 of that money that you put into the plan. It could be more, it could be less. Everybody's situation is different. The important thing for you to understand here is you would have access to a part of that. You can call it equity or compare it to equity, but this is money that you have access to. Now, when you want to get that capital, how do you get the money? What do? Well, you work with your agent, you call the insurance company, and they will provide you access to the money. There are a number of ways that you can get access to this money, and I'll cover them now. Okay, so before I get into how you access the capital inside of an IBC plan, I have to back up a little bit and make sure that I cover this. So the first principle you have to understand when you talk about banking and loans is, in finance in general, is that you finance everything that you buy. You either pay interest or you give up the ability to earn interest. Now, when you pay interest to someone else, a financial institution, this is a wealth transfer. This money is going away. You'll never see it again. And this is one of the areas that we talk about when we talk about wealth transfers. But just consider that you finance everything that you buy. And every dollar that you don't spend will either be spent on your lifestyle or it will be transferred to someone else, whether that be an entity, your family, or what have you. So we know we should pay ourselves first, and we know we should put money into some type of savings vehicle. And in this case, we're talking about IBC and a whole life insurance contract. Now, I have to be specific because these policies are sold by mutual companies only. You can't get them, these companies that advertise cheap term insurance on TV, Those are not the companies. They're not IULs, they're not ULs. They're good old-fashioned, tried and true whole life policies. They've been around for hundreds of years. They work. That's why we use them. They're engineered to get better every year. So this is the contract held within inside your personal economy because you own it, you control it. Again, the premiums are relevant to your situation, your earning capacity, your income, your health, and a few other variables. But you can put whatever amount you have the wherewithal to do so. All right? And your policy will have a death benefit from day one. This death benefit will grow every year, guaranteed, if it's one of these types of policies. The cash value in the policy will also grow every year, guaranteed. Okay? There is no specific number. Every company and how you treat your policy will make the difference. So what are the options to access the capital? Okay, so now that you understand that you finance everything you buy, because people say, oh, I don't want to borrow from myself. Well, you're not necessarily borrowing from yourself. We're using the company, your collateral capacity, meaning your cash value and your death benefit would be the collateral. Something happens to you, they will get paid, okay? So, because it will come right out of the death benefit. So the first way to access the capital is through a loan. You can borrow money from the insurance company using other people's money, your money that's in this pool of capital for the company. And again, if you don't quite understand this, it's all in the book, Becoming Your Own Banker, and you can access some of my other videos to go through with that. You could also surrender part of your cash value of the policy. And you could get dividends. Now, we don't recommend using the surrender privilege because you're killing the goose that lays golden eggs. Again, your policy is going to get better every year. And dividends are a way that maybe later in life, or now you could do this anytime, but you could use these. Actually, I just had someone call me today that's retired and want to just start to take their dividends as cash and not have the policy grow anymore. So you could do that. Now, let's talk about how you actually get money into the policy. How do you increase your collateral capacity so you have more money to borrow? So one of the rules of IBC is don't be afraid to capitalize. So you can make contributions to the plan, all right, in the way of premiums or additional payments to PUA, paid up additions. And again, I go further into these things in my other videos. And then also internal growth of the policy, which like we've mentioned is guaranteed to grow every year. And then if you do have loans, by reducing the loans. With lien reductions, paying off the loans, the money, again, is back into your collateral capacity and the policy is continuing to grow. So a question that comes up often is, why borrow the money if I can just pay cash? So before any capital outlay, before you spend any major amount of money, you must consider not only the cost of what you're spending the money on, but the lost opportunity cost. What is that? Well, if you have, let's just say $1,000 sitting in an account, hopefully it's earning some type of return. And if it's not, then it should be. So anything more than that, let's just say. But when you spend that money, in other words, you've taken the money out of the account that was earning a return, then you've lost the opportunity for that money to grow anymore, right? It cannot compound, it cannot grow. So you must consider the opportunity cost. So it's not just what you pay for it, but it also includes that lost opportunity cost. So, well, what would I spend money on? Well, there's life. Remember, life, it costs money to live, right? And we will probably have emergencies sometimes in our life, meaning the car breaks down, the air conditioner breaks at the house, or the roof needs replacing. Whatever it might be, we will have expenses. And they're sudden, they show up. So where do you get the money from? Well, most times people, they go to their credit card. They open some type of 90-day account, but they typically will borrow money in the case that they do not have the capital there. And you might say, well, I do have capital. I got capital in the bank. Okay, well, I'll spend it. Well, hopefully that money in the bank, again, was earning some return. If it's not, trust me, the bank is using your money to loan to other people. So that is something that you will have to consider. Also, opportunities. Have you ever, for instance, right now, people are saying it's a buying opportunity with Bitcoin, or maybe it's real estate, whatever it might be, but you have opportunities that arise. And so having access to capital is very important. And then there's cash flow. Maybe you're not making as much money now because of the pandemic. Maybe you're making less money and you need access for cash flow. So that's where it could come in handy. Also, if you're a business, you know, cash flow is king. So we need money to operate. So this is another example. And then perhaps someday, again, you may not be working and you will need some type of income. And again, this would be passive income because the policy, the contract would be performing, it's growing, and after a certain amount of time, let's say 10 to 20 years, this capital it would be ripe for income. And so the longer the policy is in force, the better it's going to be, the more income you would have available. Okay, so let's talk a little more about this life insurance contract and its collateral capacity. So again, it grows every year. Now, it's guaranteed to grow, but there's also some compounding that's going on. Remember Einstein, the eighth wonder of the world? Okay, so we want uninterrupted compounding. So if we're not using our capital, whose capital are we using? Well, again, we're using the contract as collateral with the insurance company, okay? They're loaning us the money and using our death benefit and our cash value to reduce our collateral capacity. So let's say we took a loan, okay? We would repay the loan. Meanwhile, the policy continues to grow. Now, the loan doesn't have to be repaid, but it's best to repay the loan during your working years. Once we get to a time where we're depending on passive income or retirement, we may not repay the loan, but the policy needs to be seasoned at that point, all right? Meanwhile, the policy is growing every year regardless of the fact that it has a loan against it. Your collateral capacity is continuing to grow because you did not use the capital, you used other people's capital. You used the capital of the company using your policy as collateral. So the ways we increase our collateral capacity is through contributions, premiums, internal growth of the policy, and lien reduction. When we repay the loan, the capital is back into our collateral capacity so we can use it again. Just want to share some of the benefits that come along with this type of IBC, infinite banking financial plan. So in this video, I'm not trying to compare this to other plans, but I'll leave this up to you if you want to ask yourself, does your other plan offer you these options? So we've already discussed protection, savings, and growth, okay? But what about things like tax deferral? Okay, that's a good benefit. You get that from many qualified plans, IRAs, 401ks. But what you don't get with those types of plans is tax-free distribution. You might say, well, I have a Roth, I get that, okay. But there's lots of limits on Roths. So for instance, you can't earn a certain amount of income and have a Roth. You can only contribute a certain amount per year. So same with a 401k or IRA. There's limits on how much you can contribute. So there are no limits with an IBC type plan. The only limit is your net worth or your earnings capacity. So whatever you earn, that will be relative to the amount that you could get. Okay, so the underwriters will determine this, and again, rarely is this ever an issue. Competitive returns. Now, when I talk to people, that's almost always the first thing that they say they want from their plan is a rate of return. Well, there's competitive returns. It's not going to touch things in the market, but there are no loss provisions. So you can't lose the money once it's in the plan, all right? It's guaranteed. Again, back over here, the death benefit is guaranteed to grow every year. the cash value is guaranteed to grow every year. All right. There's also other benefits. What about a disability benefit? The waiver of premium will pay the premiums, the contributions, in the event that you're fully disabled. Okay, there's also long-term care riders and other things that you can add to a policy if so desired. So those are some of the benefits, and you just have to ask yourself, does your other plan do that? Do you have a death benefit? Do you have a disability benefit? Do you have access to capital on your terms? So you have guaranteed accessibility to the capital through via loans. You also have unstructured payments, so you can make the payments on your schedule. You can pay principal, you can pay interest, you can not pay principal and not pay interest. Okay, this would again add to the lien. Interest is due every year, but you can pay this back on your schedule. Okay, so let's recap and I'll finish up here. We're talking about infinite banking, okay? This is a lifetime financial plan that can be used in conjunction with any other plan, or it can stand alone. It's the only financial plan that I know that can stand completely on its own because it's built around custom designed whole life insurance through a mutual company. Now you can learn more about this by watching my videos, and required reading is becoming your own banker. So you'll want to do that first. This plan will give you protection, savings, and growth, but it will also offer liquidity, use, and control of your money. So we're going to take our earned income, whether it be a portion or all, and we'll put it into this plan. Now, of course, not everyone can start out with all of their income, but this could happen over time. You start out with what you feel comfortable with, and again, an IBC practitioner can help you with this. So this is your personal economy. You control it, you own it. You're going to have expenses. No, we don't always recommend using the policy to pay expenses, but I'm talking about cash flow needs, emergencies, okay? Cost of living, once you've built up your collateral capacity, all right? So we put our income into the plan. We take out money for expenses. We may find a business opportunity. We may want to finance automobiles. Wherever you need or you have a major capital expenditure, you could use the money in this plan. You could borrow using your collateral capacity against the death benefit and against the cash value of the policy, which is growing every year, guaranteed, okay? So regardless of whether or not you take a loan out of the policy is going to continue to grow, okay? And if you do take a loan and you repay it, what you have is uninterrupted compounding of your money. The amount you put in is totally up to you, determined by your goals, your earning capacity, your net worth, and your health. All right? So, again, what we're trying to avoid is wealth transfers to things like taxes, interest, and fees, right, that come with other plans. And we're also avoiding risk that are in the markets, and other assets hold risk, all right? You have options to access capital through loans, surrenders, or dividends. You have an ever-increasing collateral capacity through your contributions, through internal growth, and lien reductions when you repay your loans. Why would you ever want to borrow from your policy or your plan? Because, again, life costs money. So there might be emergencies, there might be opportunities, things that you want to invest in, but you want to run the capital through your system first versus having to borrow from a financial institution, okay? So emergencies, opportunities, cash flow for expenses that you have, or again, if you're in business, you know you need cash flow. And eventually, for passive income, if you want to retire or someday you're unable to work. Now, you may have questions, so please leave your questions below. Again, I was just trying to give you a new start, an alternative for the new year, and a new plan that, if you're concerned about what's going on in the economy, the markets, something that can be used in conjunction or as a standalone plan. So this is the infinite banking concept, how it works. And I thank you for your time today. I hope you got something out of the video. Please give me a thumbs up if you did. Be sure to subscribe so you'll get my latest videos, and I'll see you in the next video.